Okay, I'm delighted today to be joined by one of the sort of longest standing managers in the ILS industry and a founder and now co-CEO and President of Nephila Holdings and a Director of Nephila Capital, Frank Majors. Frank, thank you very much for joining me today. It's a pleasure to talk to you.
Thank you, Steve. Appreciate you having us.
So what I was hoping we could do is just run through some questions about sort of how the current crisis is affecting your business, I guess, what you're seeing in the world of the insurance and securities market right now and reinsurance more generally. And I guess the industry as a whole is having to adapt itself, its working practices right now. And how is Nephila adapting to this new world? Are you finding any issues within your extensive business platform? Has virtual working come easily to everybody? I'm interested to hear your view.
Yeah, we've been really fortunate so far. We've got offices spread around, so we had put in quite a bit of technology infrastructure so that we could, hold virtual meetings. And we have a pretty young, pretty mobile workforce. So everybody had laptops. So frankly, the work from home issue has been pretty seamless for us. Obviously, it comes with its challenges. We have some, two working parent households who are now homeschooling. So some things around the edges that, we have to be mindful of and try to accommodate. But so far, really good. The only real complaint we've heard is we have those standing desks that go up and down, and we're having a lot of complaints about backaches from sitting all day. So I've made a makeshift standing desk at home, and I think some other people have. But other than that, we're doing okay. Thank you.
Sure, I think ergonomics is going to be an important factor for the market going forward, isn't it? So that's the Nephila side of things. But how about from your interactions with the market generally? Are you finding people are adapting okay across reinsurance and ILS?
Yeah, I think so. I guess it's a industry that's used to disasters and catastrophes and figuring things out on the fly. And we've really seen good inflow on business. We're getting our fund NAVs done on time. We got our audits done on time, so the service providers are answering the call. Really, frankly, the only thing that we noticed was a little bit of a temporary slowdown on submissions on the velocity on the insurance side.
Okay.
And I think that's probably because they're dealing with end businesses who have different levels of sophistication around, technology and communication. But that's picked back up and actually it's rebounded to be higher than it was at this time last year. So really, and the inflow on the reinsurance side, it seems like it's going to be an early market. People are trying to wrap up capacity. So we're sort of all systems go and things seem to be going well.
That's good to hear. I mean, yeah, that's similar. I'm hearing some urgency among cedents in making sure the capacity is there for them at this time.
Yeah.
So and that helps everybody really if they can start the renewal early and wrap it up quickly.
Yeah, there's a lot of uncertainty out there, right? And so anything that you can tie down and remove some uncertainty from your business, it makes sense to do that.
Sure, yeah. And what are your thoughts more generally on the prospects for sort of catastrophe bonds and other ILS investments in the shorter term while the pandemic is still sort of at its peak and shutdowns are a factor across the world? I mean, obviously, we've seen some impacts to funds in terms of investors looking for cash from cat bond investments, and but I mean, it's not really stopping. It's stopped some business flow, and we've seen one cat bond pulled from the market and then come back again with better improved pricing. Do you think that's going to be? Is the market just going to be a bit sticky and slow for a little while, or?
Well, if you mean the cat bond market specifically, I mean, it's still functioning well. We've been very active in that market. At some parts, we were selling to try to get ahead of what we thought might be some macro hedge funds unwinding their positions. I mean, that's always the first thing that happens, as we learned in 2008, 2009. And then, we're seeing some attractive opportunities here and there as well. So I think the secondary market is still very vibrant. I think the primary market, again, I think that does seem to slow down a little bit. There are some new issuances, but I think we expect that to, there are a lot of deals maturing. So there's an expectation of some pipeline. Now, whether that full cohort of expiring deals renews or not, that'd be a big ask. So the short answer is I really don't have a real view on the primary issuance market. We're just watching and waiting. But I don't know if your question was broader than just the cat bond market.
Yeah, I'd be interested in your thoughts on the sort of collateralized side as well. As I mean, you said you're still getting the submissions, and it's now picked back up to a pretty typical pace. So you expect sort of the renewal to go ahead in a timely manner, and you're not seeing any sort of changes in appetite for collateralized cover, or
Well, I mean, I don't know that I could answer the question as specifically or narrowly as like collateralized versus, where we front using,
Mhm.
one of our partners or we write it on a Lloyd's syndicate. I mean, I think we are seeing increased demand for cover,
Okay.
obviously, and I'm sure that that's going to be price sensitive. I'm sure there are a lot of people who are just checking out the market, and at some price they would buy that new top layer, and at some price they wouldn't. So we're just still trying to figure out where the market clears.
Yeah, and I guess it's still quite early days for a lot of cedants to really know what they need at mid-year, as well as they're all going to be hoping their asset portfolios bounce back somewhat by then
Yeah,
as well, and improves their
yeah,
solvency capital, I
I'm
guess.
sure.
Yeah, and then sort of on a longer term basis, what are your thoughts for sort of how going through another 2008 like I guess crisis or occurrence for the ILS market? How's that going to affect sort of things like investor demand going forward, do you think?
Well, I think generally speaking, any asset that's uncorrelated should be attractive, right? And so, I think that, and the world's not getting to be a less risky place. So I think the demand for risk capital is going to go up. So in some form or another, we definitely expect capital to flow into the market, and I think this is going to be a very interesting test case though, because I think that this does test the sort of collateralized or ILS business model to a certain extent, and I think commentators have been waiting for a good test, and there was some question whether IRMA was the test or will something else be a test. I mean, I think our view is that, certain risks are equity type risks and certain risks belong in a broader, more diversified portfolio. And I think how the industry deals with this COVID coverage issue is going to be really fascinating and is going to have a lot of implications for, frankly, everybody's business model, whether it's an insurer, a reinsurer, or an ILS fund. So I think it's too early to really answer exactly how it plays out, other than to say that, we do think that the demand for uncorrelated assets is going to increase, and the demand for ways to hedge risks is going to increase. So somebody is going to benefit from this.
Sure. And I guess also at times of crisis, you often see innovation
Yes.
coming out of the market as well. That's been historically how large catastrophes and things have
Mm.
driven innovative solutions. So yeah, I would personally hope to see some new product opportunities and new structural opportunities coming out of
Mm.
all of this. And the testing of the market is obviously a good
Yes.
thing as well, really, because the business processes getting tested always results in something more
Yes.
robust being created at the end. So on the investor side, I mean, how are you seeing the reaction from your investors and other investors that you speak to compared to, I guess, the last time we saw this in 2008 when there was a bit of a crisis around financial markets and global markets in
Yeah,
general?
it's a great question. Our experience has been very different. And I don't know if that's because the asset class has matured. I mean, this is, as we like, this, I guess, our 23rd year. So obviously, I think that the asset class has matured. So I don't know if that's why it's been so different or if it's because our investor base is so different. I mean, the vast majority of our investors now are pension funds, so they're actually acting as a principal. Back in 2007, 2008, there was a lot more intermediation in that capital flow, fund to funds, classically. And a lot of those
Yeah.
investors that were in the ILS space in 2008 had liquidity needs on their end. And so we lost something like, I don't know, 50% of our assets in 6 months because we honored all our redemptions. So that was a very scary time. This time, because we're dealing with pension funds, and they've been around with us for a while, and also they don't have those same liquidity demands. We have seen, low mid single digit redemptions, which has been fantastic, and a bit of a sigh of relief. It makes sense. They have certain rebalances. They've got targeted equity holdings. When the equities trade down, they need to rebalance. They call from all their other assets. We've seen that sort of thing, but we've seen no. In fact, I don't think we've had a single investor who's completely redeemed from the platform. It's been a little bit of trimming here, a little bit of trimming there. I think that's correct. Don't hold me to that. And so it's been a very different reaction, and I'm sure that's true across the whole ILS market. The investor base is very different than it was in 2008. I would say the one exception to that
Yeah.
is,
No, that does.
sorry, Steve, the one exception to that, and you do see it in the cat bond market. I think
No,
a
go
lot of
ahead.
multi-strat hedge funds did own cat bonds. So that is an investor base that was around in 2006 and also 2008 and 9. And so we saw a little bit of selling there, as I alluded to earlier. But other than that, it's been pretty steady.
Good, good. Yeah, no, that seems to be the sentiment of most of the market, that on a sort of percentage basis, people are seeing some redemptions, but it's a lot of it is the readjustment of sort of allocations for these investors, given there's potentially opportunities coming up for them elsewhere as well. And I think generally the perspective is that the majority of investors who are longer term are going to end up increasing their allocations to ILS in future as it proves out its lack of correlation once
You know,
again.
you made a great point, because even though the capital hasn't left, I mean, I think that we're very aware. I mean, one of the implicit deals in our business model is we do think we have a lower cost of capital. But part of that deal is that that's because our capital providers can withdraw that capital when they see better opportunities elsewhere. So while our capital bases remain relatively stable, we feel like our cost of capital has gone up, because our investors do have other assets around the world have repriced, and their other opportunity is paying more than it was, 6 weeks ago. So while our capital base is, I would call, stable, it doesn't mean there isn't an impact on our business. We can't take it for granted. We've got to sing for our supper to justify our place in that allocation. And, we take that seriously as a fiduciary.
Sure, sure. No, and that obviously has ramifications for renewals and all sorts of other points in the market. So I guess just you mentioned the sort of the business interruption issue that is being widely discussed at the moment. Obviously, a lot of it is related to litigation and potentially legislation in future, and potentially backstops and things. I mean, do you have any sort of view on how the industry will deal with this, or is it just going to be a case by case basis, and is it actually going to come down largely to wordings and their robustness?
I mean, I would say that it probably comes down to wordings and their robustness. I mean, I may regret saying this, but I think that from a legislative perspective, we're not really that concerned about a legislative retroactive action. Obviously, we're watching what the prospective action is, and is there a role that our capital could play in solving that problem so that they can, generate a return for themselves. We always think that you make a return by solving somebody else's problem. So we are looking at the prospective legislation, but we're not that worried about the retroactive legislation. So I think that the two areas of concern that we have are judicial interpretation of contracts, obviously. I think the contracts are pretty clear about what's covered and what's not, but these are uncertain times and we're not taking anything for granted. So I think that our expectations are that this should not be that big a deal for the industry, but we're preparing in case it is. And then if that gets, depending on how that happens on the front lines, how that gets propagated through the industry is going to be very much contract by contract specific. Hours clauses, exclusions, named perils, all that sort of stuff. So I think it could be a mess. And when you think about implications for the ILS market, we definitely are wondering what the implications are about like trapped collateral, things of that nature, because whatever is going to happen, it's going to happen slowly. And so this is something that, I don't wake up every day thinking about being a champion for the ILS market. We just think about what's about Nephila and, doing what we need to do. But I do think that we need to think about, we buy collateralized reinsurance, we sell collateralized reinsurance. How is that contract what is the basis risk in that contract compared to the exposure that people are taking on the front lines? So I think it's fascinating, really fascinating.
Sure. But it also shows up a bit of a gap as well in terms of coverage, really.
Which can be totally legitimate. That can be totally legitimate. But it also then makes people reassess the value of the product that they're buying and selling, So that'll all be worked out.
Yeah, and coverage needs to be paid for commensurately with the risk as well. So let's fast forward a little bit to sort of June. Obviously, an important renewal cycle for the ILS market and for Nephila. And as a result of the pandemic, and obviously there's a potential flow availability for the renewals may not be as robust as it's been in recent years. But what's your outlook for the renewal in general? Are you positive about it, and also positive about how the market will respond in terms
Well,
of
I'm
rate?
scared I may have softened the market by dispelling that rumor about us having massive redemptions. I think that a lot of people were counting on that to keep the market firm, but unfortunately, that's not the case. Or fortunately, that's not the case. I mean, joking aside, I think we expect a pretty robust market. We were expecting a firm market anyway. As we've repriced the book based on experiences in the past, some of the operating models of some companies, and obviously the cost of capital has definitely gone up. So I don't want to talk the market up, but I think we're pretty bullish that there should be some opportunities.
And are you seeing specific opportunities coming out at this time?
Yeah. Oh, yeah.
Are you beginning?
Oh, yeah. I mean, very early. So the June 1 renewals, we've already gotten several firm order terms, whereas last year, we might not have gotten firm order terms on those contracts till, third week of May. People, I think, very wisely are trying to button down their renewals. And frankly, I think a lot of people in that market probably welcome this. I think that, if I were operating I'll just take Florida as an example. If I were operating an insurance company in Florida, I would want differentiation. I would want to compete. And whatever there are, I can't remember, 50 odd companies down there with the same business model. They're going to be winners and losers. And I think that probably there are a lot of people in Florida running companies that are happy about that. And that's just capitalism.
Yeah. I think the quarterly results that are about to come out for the traditional market will be interesting reading for everyone, and may stimulate a bit more early buying, I guess, or at least arrangements for renewal as well.
And we have seen buying from, not just the Florida carriers, but global carriers, bigger carriers. So, I mean, there's just a lot of uncertainty, and, risk appetite's down.
Sure. Okay, so finally, what do you think this could all? I'm going to ask you to get your crystal ball out. And do you think this is going to mean further changes for the, I guess, risk transfer, reinsurance, ILS market, whatever you want to call it? Is it going to further accelerate the focus on getting capital and risk closer together, making that connection as efficient as possible? Now we're all looking to more efficient business practices in terms of working remotely. Is this going to heighten the need for efficiency within the risk transfer business as well?
Well, I mean, we have to assume that, the new normal is not going to be the same as the old normal in any walk of life, I'm guessing. I don't have any special vision into this, but I mean, I think the short answer is, we'd expect some changes. I think more specifically, it will be interesting to see. Well, I would just say, for somebody who is involved in insurance, with a firm that's involved in the insurance market and the reinsurance market, we understand there's uncertainty about how all this COVID plays out, but there's a difference between having transparency with uncertainty and having no transparency and uncertainty. So, the further we are down the chain, trying to play the what if game, which is where we're spending our time, what can go wrong and how do we get prepared for it? It's a lot easier to do when you have transparency. So when you're trying to ask somebody for information, who's then asking somebody else for information and so forth, there's a lot of intermediation that is expensive and is also destroying information value. And at times of peak uncertainty, information is absolutely critical. So, I think finding a way, and again, we're not trying to disintermediate anybody per se. We're trying to just make sure that the whole model works as efficiently as possible, and that important data is captured and made available to people who need it when they need it. And so there has to be some changes around that, right? I mean, right now, everybody I talk to is pulling files, looking through files. I mean, really? I mean, there should have been a better way, I think, to store this information and transfer this information. If you're going to transfer the risk,
sure,
you need to pay for that, and you need to supply the information that does it. And we see that on the insurance side in a way that, we don't necessarily, the further are we down the chain. We are down the chain.
Okay, that's really interesting and a very good point, because often intermediation is pointed at as the thing that we need sometimes less of, but actually what we need is more efficiency there rather than actually a reduction of the intermediary.
That's right. Yeah, because I think that a lot of the brokers we deal with have added a ton of value, bringing information that we don't have because they have a seat, they see across the whole industry, and so providing context and interpretation and data has been super valuable, and we're always happy to pay for that.
Sure. Great. Okay. Thank you, Frank.
Yeah.
I won't take up any more of your time. I really appreciate you sparing us
You bet.
some of your day today. It's been great to talk to you again, and I wish you well.
Thanks, Steve. I appreciate it. Take care of yourself.